Should investors be wary of the president's latest comments on trade and tariffs? Let's bring in former Cantor Fitzgerald CEO Shawn Matthews is here. Of course, now chief executive at Hondius Capital Management, as well as Brian Levitt, senior investment strategist at Oppenheimer Funds. Guys, good to see you both.
Thank you.
A lot of commentary, Shawn, about how the president's rhetoric seems extemporaneous, off the cuff, often contradictory. Market doesn't know what to discount anymore.
Is that shocking?
Yeah. I mean, Cash had just said we've seen this movie before. So how do you curate this? How do you process this?
I think we've seen this movie before. I think he's going to do the same thing every time. He is negotiating beforehand. So right now he's trying to talk about how potentially a terrorist will come in if nothing happens that goes his way. This is just his negotiating style. So it's nothing more than that.
All right, but people still have to make investment decisions.
I think if you're making investment decisions based on, a week in advance kind of, pre-game talking, you're really trading. So you're talking about trading in the, day-to-day basis. That's something that's different. If you're talking about investment decisions, something drastically different.
What do you think, Brian?
So I think that that's the right way to think about it. I mean, obviously, if you're a long-term investor, you should look through the noise. If you're trying to outperform in the short term, you really have to, consider what the ultimate outcome of this is going to be. I suspect that the negotiations, we put it out there, the president puts it out there, and then slowly walks it back. And ultimately, I think that eases some pressure on the dollar, and we get into an environment where the U.S. slows and is in more of a Goldilocks rates and inflation environment. That should be a good thing for risk assets globally. If I'm wrong and we go too far on the trade war, it's going to be strong dollar. It's going to hurt corporate profit margins, and the markets are not going to post good returns in 2019.
And Shawn, there has been a lot of, I guess, for lack of a better word, noise, including the Fed chair Clarida's comments earlier this morning. What's your takeaway from that?
Look, I think the word productivity is going to come out more and more over time here, right? So that's going to be the key driver if they can stop raising rates. And, they're just starting to now let it out there. I think they're going to talk about it in immense ways over the next 3 to 6 months, because they need productivity, or at least the perception that productivity is going to go up, to be the reason that they don't raise rates anymore.
Clarida said as much this morning about productivity and core capex, which is not the most encouraging chart in the world. Brian,
it's not, and it's not. And a lot of the money that came back into the United States was used for buybacks. We did not see a significant surge in business investment, even with sentiment at the levels that it was. I think the key point that the Fed needs to be watching, and we should all consider, is the U.S. still a rate-sensitive economy? And in my mind, it is. I mean, we're seeing housing slow. We've seen autos slow. The U.S. economy, make no mistake, is slowing and will slow into 2019. And I think long rates will start to come down. So the Federal Reserve, if they continue to raise short-term interest rates, will further flatten or invert the yield curve. The good news is the core PCE is at 2% for the first time in years. So there's no rush to do this. Ultimately, I think the Fed will back off.
Shawn, what do you make of the fact that it seems like right now the bull case rests on some kind of relief, either on trade or the Fed, right? It's sort of like maybe expectations have been beaten down for what we can get out of the G20, but it seems as if investors are kind of grasping for some all-clear signal because we can't yet quite digest the fact that maybe earnings growth is going to slow to some single-digit number percentage growth next year.
Well, it is going to slow to single digits. So the question is, what is the value creation you're talking about? And let's face it, if you're looking at a portfolio right now, your expectations should go down to kind of 5 to 7% returns. And that wouldn't be shocking in a 2% inflation world. We had a real Goldilocks environment for an extended period of time. So it wouldn't be crazy to have mid-single digit kind of returns going forward for the next several years. And you're going to have some credit issues coming as well. So I think, stock market, it's mid-single digits going forward.
Brian, I want to dig back into CapEx because it does seem to be like one of those key data points to watch, especially as we go into 2019. Why do you think it hasn't been stronger?
Well, we've been in an elongated cycle, and businesses have had access to cash for a long time. They've been flush with cash for a long time. So businesses are going to put money to use where they see demand for products and services. And so this move back of money back into the United States, yeah, it did lead to improved sentiment, but you're only going to deploy that money if you think this cycle is going to continue indefinitely and we're in a good backdrop to continue to deploy that money. We're later in the cycle, Fed tightening, concerns about trade wars, so it puts a lid on CapEx. And, it's been good for buybacks, it's been fairly good for dividends, it's been, up until October, good for risk assets. But this idea that the U.S. was going to head to a new, higher, sustained level of growth on the back of CapEx this late in the cycle, I never really bought it.
Shawn, you You bring up corporate credit, like, we'll deal with that. You sound like you think it'll be manageable, despite Bill Cohen's op-ed today, for example.
I certainly think 2019 you'll start to see cracks. 2020 there'll be real implications, especially if productivity doesn't, really accelerate at some point here. So I do think it's manageable next year. I think 2020 will be a problem.
Why the difference?
I think you still have a wave of debt that's going to have to be refinanced that is still 12 to 18 months out. So as you start to think about those companies, and there are a lot of companies out there that aren't making money, right, that are going to have a tough time actually rolling their debt. So you have a tremendous amount, half of the investment grade bond world is BBB. By the way, we trusted the rating agencies last cycle. How did that work out? Right, so we're trusting them again, right? So half of the world is BBB. That is going to be a problem.
Yeah, but how about the fact that the credit rating agencies now are stingier than they were last cycle? So therefore, maybe that's why they fall more into BBB. Is that a factor?
Maybe, maybe not.
Yeah.
So there's still a tremendous.
No AAAs.
Well, that is true.
Right?
I don't know. So there's still a tremendous amount of companies right now that aren't going to earn money, right? So they're going to have to pay back their debt at some point in time. If they can't roll it, they can't do that, right? So that's going to be the real challenge. Now, if revenue starts to decline and you go into a recession, then it becomes a real problem, right? So we have to balance that real interesting environment.
All right, so bottom line quickly from both of you. Brian, I'll start with you. Where do investors put their money, especially if you want to position for 2019?
So for 2019, expect a slowdown in the United States. I think that's a return to favoring true growth companies in the United States. And I would start to look overseas. I know it's been a tough trade, but there needs to be a catalyst to unlock the value, especially in the emerging markets. I think the U.S. slowdown and some agreement on trade could be that catalyst.
I would be a renter of assets, so you really have to trade things. If you think about a world there, the returns are going to be relatively low. And I would use cash as a real asset class next year.
There is an alternative now.
That's right.
Guys, thanks. Good discussion.